You might not know who Micheal Burry is, but if you do, you might recall he's the man who made tons of money by predicting the housing market crash in 2008. Fast forward almost a decade and a half later, he's sending us another warning. In this video, we take a look at what Micheal Burry has to say about a future stock market crash. This is going to be pretty interesting, so stay tuned. How Burry made millions during the 2008 financial crisis. So let's jump straight into how Micheal Burry profited from the 2008 financial crisis and housing collapse. In 2005, Micheal Burry bought some credit default swaps, or CDS, in anticipation of the housing crisis. He bought 60 million CDs from Deutsche Bank, 10 million each on 6 different bonds. His prediction was that the U.S. mortgage-backed security, once a stable and respectable investment product, had slowly turned into a deceptive time bomb fueled by greed and corruption. In his eyes, the bet wasn't a gamble, and he did his research and was confident about the outcome. It was 2005 when he bought the CDs and knew that the world would take another 2 years to figure out what was happening. And he was right. By October 2007, the S&P 500 lost a massive 1,576 points. A year and a half later, in March 2009, the S&P closed at only 667 points, which was a 57% crash. Micheal Burry ended up making a massive profit of a cool $100 million and made his investors over $700 million from this single bet. In years leading up to this event, however, Burry had to hear countless criticism from the investing world, including his own investors. Criticism led him to close his fund eventually after everything was done. This was around 15 years ago, and it looks like history is repeating itself once again. Early warning. Last summer, Micheal Burry first warned about high inflation as a consequence of the Fed's unprecedented money printing. He posted many earning tweets calling out the government and Federal Reserves over the trillion-dollar stimulus checks they'd given away. At the time, things looked well. Even though the Feds were on an unprecedented and uncontrolled money printing spree, inflation stayed low. At the time, latest published data showed an annual inflation rate of just 1.7%. That was lower than the Fed's target. However, Burry's early warnings were ignored back then. Fast forward a year and we see an inflation rate of 8.6%, which was the highest in recent times. Again, Burry was criticized many times, with Elon Musk labeling him a broken clock. In the past month, Burry has been explaining extensively regarding why he thinks this economic crisis and subsequent market downturn has only just begun. According to Burry, the worst is yet to come. His prediction. According to Burry, the S&P 500 could lose another 50% from where it is now. Last year, the S&P 500 and NASDAQ indexes have tumbled 15% and 24% respectively. In tweets he's since deleted, Burry has taken credit for calling the sell-off, explained why he expects further declines, and cautioned against buying into relief rallies. The S&P 500 index has rebounded strongly from the pandemic crash in the spring of 2020, rising from a low of 2,192 points to 4,089 points as of last month. However, it could plummet by 54% to 1,862 points in the next few years. Burry tweeted on May 3rd. When the S&P 500 has crashed in the past, it has traded lower several years later, Burry noted. He pointed to the index bottoming 13% lower in 2009 than it did in 2002, 17% lower in 2002 than it did during the long-term capital management fiasco in 1998, and 10% lower in 1975 than in 1970. If the benchmark index follows that historical pattern, it could trade 15% lower than its level in the spring of 2020, Burry said. Epic and short-lived rallies. Recently, Micheal Burry tweeted, "Dead cat bounces are the most epic. 12 of the top 20 NASDAQ one-day rallies happened during the 78% drop from 2000's top. 9 of the top 20 S&P 500 one-day rallies happened during the 86% drop from the 1929 top." That's a lot of numbers to wrap your head around, but allow us to explain. A dead cat bounce refers to a temporary rebound in stock prices after a significant fall, often because speculators buy shares to cover their positions. They often occur during major declines in the stock market, Burry said in a May 4th tweet. The implication is that investors shouldn't get their hopes up about any rallies in the coming months, as they're likely to be brief respites that won't result in a market recovery. Burry noted that 12 of the 20 largest one-day rallies in the NASDAQ index took place as the dot-com bubble burst, while 9 of the S&P 500's 20 biggest one-day rallies occurred in the aftermath of the Great Crash in 1929. Burry warns us not to be fooled by stock rebounding. Stocks could stage multiple rallies before the crash is over, Burry warned in a May 5th tweet. He noted that after the dot-com bubble burst, the Nasdaq rallied 16 times by more than 10%, gaining on average 23% each time, on its way to a 78% decline at its nadir. Burry also emphasized that after the Great Crash of 1929, the Dow Jones Index rallied 10 times by more than 10%, rising by an average of 23% each time, before bottoming at an 89% decline. Stocks are on a dangerous trajectory. The U.S. stock market appears to be following the pattern of previous bubbles, leaving it poised for a monumental crash. Burry noted in a May 8th tweet. The tweet reads, "Third time's a charm, 10 years leading to a financial crisis, yellow S&P 500 2000, white S&P 500 today, green Dow 1929. Got to love human nature, nothing if not consistent." The Scion chief also pointed to the S&P 500's trajectory over the past 10 years, noting it was strikingly similar to the index's chart for the decade leading up to the dot-com crash, and the Dow's chart for the 10 years before the Great Crash of 1929. Burry suggested that human nature was behind the consistently decade-long buildups and implied that history is repeating itself. Stocks are set to tumble a lot further. In a May 11th tweet, Burry stated, "Top to bottom, MSFT traded 5.2 times its shares outstanding by 2002, 3.3 times by 2009, and 0.5 times so far. Amazon traded 5.7 times by 2002, 6.6 times by 2009, and 0.9 times so far. JPM traded 3 times by 2002, 5.9 times by 2009, and about 0.7 times so far, etc. Enough takes time." According to him, investors can expect stocks to fall a lot further down in the future. The investor noted that 5.2 times Microsoft's outstanding shares were traded between the software stock's peak during the dot-com bubble and its bottom in 2002. That figure was 3.3 times during the financial crisis, but has only reached 0.5 times so far. Burry noted it was a similar story with Amazon and JP Morgan, indicating it could be a while before those stocks and others bottom out. Now, to understand that the core reasoning behind Burry's point of view is the economy. We already know Burry's thoughts on inflation and see the Feds raise interest rates to make borrowing hard for businesses. We also need to remember that interest rate rises also affect the fundamental building blocks of the economy, which is the consumer. In large inflationary environments that bring about interest rate rises, unfortunately, consumers have less money to spend because more of their savings and income go to servicing debt. And this very frequently starts a negative spiral because less discretionary spending means less sales for the companies we're interested in. So, ideally, the consumer should be taking it in, but according to Burry, consumers aren't doing well right now. Burry noted how savings have reduced and credit card debts have increased despite all those stimulus checks. Burry warns of a consumer recession and more earnings trouble. Burry have a recent example mentioning Amazon's Q1 results. Revenue at Amazon increased 7% during first quarter compared to 44% expansion in the year-ago period. It marks the slowest rate for any quarter since the dot-com bust in 2001 and the second straight period of single-digit growth. Overall, Burry sees inflation, interest rate hikes, reduction in consumer spending, and reduced savings with high credit card debts, and it isn't looking good. And worst of all, it's still early days. That's all for today's video. Thanks for watching.